First of all, thank you for joining in. I'm Dhruv, founder of 256 Network. Just to give you a short introduction for the folks who doesn't know, it's a private and invite-only sort of LPGP networks focused on emerging markets. And our members cut across sovereign funds, pension funds, endowments, VCPs, foundations, and ultra HNIs globally, focusing on emerging markets, but across other asset classes like public debt, commodities, and even art. And we have subgroups within 256, which includes fintech, SaaS, gaming, and emerging fund managers. It's been 3 years we've been running this, and right now we are 600 members with some $3.9 trillion assets, with 400 plus asset management firms and 27 countries. And over this time, we have hosted some 50 plus gatherings across the planet and made numerous connections, which have resulted in partnerships, funding, and some serendipitous meetings, which have only enriched our growing and startup business ecosystem. And this is our second episode of our EFM club, which is under 256. It's a global network for first-time fund managers. And the primary objective here is to use the patronage of a larger 256 investment community to support the fund managers here. And we begin the series of these sessions to sort of decrypt the challenges of getting things off the ground. And this is the second session we're doing. Learning from Fund 1 is the topic. And we have some stellar EFMs, LPs, and GPs here talking about portfolio construction, fund strategy, as a first-time fund manager. And we have some stellar set of people. We have Pranav Pai, 314 Capital, Maggie, Green Cow Capital, Rajesh, Raju, Kalaari Capital, Conwell, Rarebreed Ventures, Amit from Tower Ventures, Raveen, Sastry from Multiply Ventures, Ekta, Tolani, Alsa Group, and she's starting her own family office. And yeah, I think we have missed one. Sorry. Just a second. Yes, I think so. We are good to go with and Arjun from Speciale. So I think this is our panel, and I would ask Arjun, Akash to take it over and lead the session with some bit of introductions more, and see how we take it forward. And thank you all for joining in today. It will be a 90-minute session, and we'll be recording this session and put it out in a larger network. And hope you have fun in the network. Thank you so much, guys. Arjun, Akash, can you take it over? Yeah.
Awesome. Thank you so much, Dhruv. A lot of familiar faces here. So hi to one and all. Good morning, good evening, depending on where you're joining us from today. My name is Akash Bhatt, and I work for a fund called Scrum Ventures. We're a Japanese fund based in the Silicon Valley. Welcome to today's session, where we've got a fantastic combination of second-time fund managers with debutant GPs, and of course, LPs who have invested in both these type of investors. I'll do a quick intro for panelists before we kick things off, so that we set context for everybody who is joining in today, as well as who'll be listening to this at a later point. With us on the panel today are Maggie Sprenger. She's the managing director at Green Cow Capital, a seed stage fund seeking diverse founding teams leveraging deep tech to solve problems in foundational global industries. She's also part of the Kaufman Fellowship program, class of 26, as well as a graduate from Wharton and UC Santa Barbara. We've got Rajesh Raju, who is the managing director at Kalaari Capital. He has been a VC in India since 2010. Some of his marquee investments include Elastic Run, Simply Learn, Haptic, Imbibe. Rajesh is a graduate from Booth School of Business here in the US, University of Chicago, and Speciale. We've got Pranav Pai, founding partner at 314 Capital, an early stage VC fund based in Bangalore. Some of their marquee investments include companies like Jupiter Money, Darwinbox, and Licious. Pranav is a graduate of Stanford University. We've got Mac Conwell, founder and managing partner of Rarebreed Ventures. Rarebreed is a pre-seed stage fund that invests in exceptional founders outside of large tech ecosystems earlier than anyone else. Rarebreed takes a very concentrated approach to portfolio building by writing checks of upwards of 250K as the first check in most of these companies. He's also part of the Kaufman Fellowship class of 26 and a graduate of Marquette University. We've got Arjun Rao, general partner at Speciale Invest, a pre-seed deep tech firm based out of Bangalore. Some of their investments include Agnikul, ePlane, and Wingman. Arjun is a graduate of NIT in Karnataka. Ekta Tolani, she's representing the LPs here on the panel today. She's managed the family fund for Alsaya and is now in the process of setting up her own family fund called Unity Ventures, focused on impact investments. She's a graduate of Booth School of Business as well. We've got Amit Garg, co-founder and managing partner of Tau Ventures. Tau is an AI-first, seed-first VC fund based in Silicon Valley and has an AUM of 45 million. He's now raising his second fund. Some of their marquee investments include ABSI, Biotia, and Armor Code. He has an MBA from Harvard Business School and 2 other degrees from Stanford. Lastly on the panel is Raveen Sastry, the founding partner of Multiply Ventures. Some of their investments include Noah Benefits, Techie, and Riaz. Raveen was the co-founder of Mintra and Hoop OS. He's a graduate of McGill University. Well, now that we've got all of the intros out of the way, let's jump into why we are here. Running your first fund is obviously a lot of work, which involves raising capital, managing relationships, building networks and pipelines, credibility and teams, but most importantly, also investing that capital. All of that comes with some sort of pressure, let's put it that way. They say that VC years are dog years, meaning that even a short time spent in venture capital can seem like a long time and give you a lot of learnings. Now, having said that as the context for this, I'm going to throw 2 but similar questions at everyone here today. What have you learned overall from being a fund manager? And what do you remember from raising and running your first fund that has helped you become a better investor in your second? This may not be very relevant to everybody here, but I think, Pranav, if you could set the ball rolling for us on that, it'd be fantastic.
Thanks, Akash. Second question first, I guess. What do I remember learning? I definitely agree that VC seems like dog years on steroids. I've aged much faster than I thought was possible for me. And I think you're absolutely right when it comes to learnings. There's a terrific demand on what you know and how quickly you can compress that into something you can action. So I think the 3 things I've learned, venture capital hasn't evolved as an industry as fast as the startups that it funds, and obviously the innovation it supports. So when we studied the asset class, we just saw so many ways to exploit what wasn't changing to our advantage, from structure to fees to the ways funds source. And obviously crypto was just starting out. So even like brand new areas were being created across the world while we were starting Fund 1. So we learned a lot about how to think about securing our own future, even before we started. And that's what's kept us on the edge. That's what's made sure that we've always been a slightly early than even early stage is supposed to be. And I think that's been a very valuable part of our DNA. And I think one of the ways that we may lose touch with that is as we age, we build biases that prevent us from being open to new ideas. So we're also working very actively to make sure that we check our biases, and obviously, hopefully that makes us better investors as we age. So I think that's a big learning, playing this balance between patterns and biases, exploits and opportunities. There's no textbook to help you with this stuff. Even advice ages very quickly in venture capital. So that was a big learning. And that's only something that you learn by experience. It's very hard to teach this. It's very hard to explain this even. So I'm sure I'm sounding like I'm babbling, but that's the most coherent way I can explain that. Second thing I think is important, at least in emerging markets like India, that the outside-in view is that there isn't too much Indian capital in Indian venture. So a large base of the LP capital is from outside of India. It's changed obviously over the last 5 years. India has seen a huge wave of incoming LP interest, and that's fantastic. But the conclusion of the lack of Indian capital was that Indian capital isn't sophisticated enough. And we learned very surprisingly and positively that it's actually very demanding. They know exactly which questions to ask, and there were a whole bunch of things that were unproven. So you had to be prepared to answer those in spite of not having data from the market to back that up. But playing that balance of what to expect your potential clients, to your LPs, to ask you and how you give them a credible answer, especially as a first-time manager. I think that's a very important aspect of preparation that thankfully we were prepared to face. So I think that was really important for us. And that first impression, that first answer, that establishing that credibility from that early interaction, that's what's kept our LPs investing in our funds over the last 7 to 8 years. So I think that those are, I would say, the two most important things. One, you can't prepare for. One, thankfully, we were prepared for.
Amit and Arjun, would you agree with that and have similar sort of learnings? Because Arjun, I know that you've perhaps ventured into VC for the first time with your first fund. And Amit, you had spent some time with the CVC and have had some experience before venturing it out and starting your own fund. So what Pranav said, does that resonate, and has there been similar learnings, or has that been very different for you? Arjun, do you want to go first?
Sure, I'll take a shot at that. Thanks. I think what does resonate is there is a lot of unknown, right? And that has only accelerated in the last 5 years, particularly the last 2 years, given what we've all experienced in terms of the pandemic and then the tech adoption. So therefore, thematically, there's just so much that is evolving very quickly, right? And from, running your first fund, one of the biggest things at that point in time was how similar was it to angel investing that I was doing just before that, correct? And it, initial impressions were it's an extension of that, right? Okay, I have a network. I can speak to a bunch of entrepreneurs and they come to me for advice and maybe a little bit of capital, and that's a stepping stone. And you just expand that and then you build a fund. But what we've learned, at least through the first fund, that's really just scratching the surface, right? Angel investing to institutional fund running is just, is probably just 15-20% overlap, right? And the 80% is where, the reality lies and the hard work lies, right? In terms of understanding that you're building an institution, you're building an organization, as opposed to you're just investing, right? I think that subtle difference is what has dawned upon us. We knew it theoretically, but to put it into practice, right? And I'm not saying we're already putting it to practice in our second fund right now, but it is a lot better from what it was 3 to 4 years ago, right? Because we think about so many other aspects and we prioritize those aspects when we run the fund, right? And that means process, people, organization, right? To make the engine of investing that much more efficient, right? While in the beginning, we're just looking for the best deals. We're just looking for the best entrepreneurs. We're just trying to get into the best deals, right? And that mindset slowly evolves into how can we see more? How can we qualify better? How can we connect the dots from all the learnings, correct? Is it fitting into the overall fund structure, right? So many aspects of running a institutional fund, have really been, amazingly eye-opening and have been an amazing learning journey for me over the last 4 to 5 years. I'll take a pause there. Maybe Amit should dive in a lot more.
Yeah, Amit, you want to go ahead?
Sure. Everything Pranav and Arjun have said resonates a lot. And by the way, Akash and team, thank you for organizing, hosting. This is an incredible group of people you got together. So I used to work at 2 VC funds, and I've started my own company here in Silicon Valley. I also worked at Google at the start of my career, and I brought all of this combination into Tau Ventures. And I think what Arjun is saying about building an institution is really true. I like to joke, putting the fun in fundraising. And in some ways, this is a startup. I like to tell our entrepreneurs, anybody we engage with, that look, I am an entrepreneur also. I used to be one on your side of the table. Now I'm on this other side of the table, but I'm still building my own company. So we did everything that many fund managers do. We warehouse deals. We took our angel investments and we put them in. We do co-investments so that when we are making a deal, we bring our LPs into it, whether it's directly on the cap table or whether it's SPVs. We started off with a smaller fund, showed results, and then when our LPs and prospective LPs saw the results, we said, okay, you know what? Now let's raise a little bit more capital. We created an opportunity fund, so we have 2 vehicles. So all of these different things are ways to basically hustle. That's the best word I have. It's hack it, right? Like if you are creating a first fund, no matter your pedigree, no matter your credibility, no matter your track record, you have to build something from nothing. And that was our experience. We, both my partner and I think come from very good backgrounds. He had also built companies. He had done computer science at MIT, undergrad, masters, HVS. So we had very good networks. We were very blessed in having very good networks. And even then, it is about building the parachute as you fall from the cliff, right? I think that's true of every fund manager that I've talked to, which is you have to be willing to take the trash out. You have to be willing to do everything. Like we, for instance, do pretty much everything in-house to save on costs, like our administrative, our capital calls. I'm not outsourcing it to somebody else. I'm putting myself through all that pain and suffering because A, I can do it more efficiently. B, I understand what needs to be done. So as I grow this institution, I can find the right set of people to manage it.
That's fantastic. Now I want to bring that conversation to Maggie as well. Maggie, what's been your experience? You've kind of like built your first fund, you're out fundraising for your second. You're perhaps at that journey more recently than some of the other panelists out here. So if you were to like quickly look back and take away some things that you perhaps may not have done and taking that into fund two, what would those be?
I'm going to be building on what's already been said so well is our big transition from fund one to fund two was also not only building a fund, but building a firm. And so to be a lot more methodical around process and how we specifically hedge risk, right? We think about hedging market risk with a multi-year deployment. We think about company risk with a very specific portfolio construction. And we're thinking about the back office items that Amit and Arjun were referencing that are so critical and driving alpha through that process. I spend a lot of time thinking about why is it that emerging managers tend to outperform? And I think so much of it has to do with the points already highlighted, which is that we're founders also, and we are out hustling and doing everything we can to drive success in this. And we are the people who will pull that all-nighter to get the job done. And for us, the opportunity for those learnings from fund one to refine them and to make them better and more structural for fund two has allowed us to really accelerate a lot of the takeaways that we developed early on.
Raveen, I want to come to you as well, because you've been there as an operator, very similar to Amit, and you're now on the other side of the table. What has been your experience in running and managing your fund?
Yeah, no, it's very early in our journey, Akash, and first, thank you for having me here. We're just closing our first fund in the next few weeks, so it's early in our cycle. So my learnings, so I think one of the biggest learnings for us is, the product itself, the capital is not your product, right? What you're really selling is, in a lot of ways, it's a concept, right? So it's really, kind of sticking to putting your neck out and really saying, hey, this is the strategy I'm going after, and this is why I think it's going to be successful. And I think capital is just, kind of commodity, right, end of the day. So for us to really figure out why this concept is going to, ideally outbeat, I guess the public markets, etc., and give good returns to LPs. I think that's been a huge learning for us, especially coming from a more operational background, right? All three of us GPs come from an operational background. We don't have fund management experience, right? A lot of angel investment like Arjun, but really no operational background, no fund management background. So for us, I think a big learning has been to kind of think about how we're going to deploy capital, when to be aggressive, and when not to be. And I think that's something that we're going to have to learn, especially with what's going to happen to India over the next 10 years. I know, 3 and 4 has been, extremely aggressive and which has really paid out well. And there've been some funds that have been passive and it hasn't. So just kind of figuring out patterns, trends, etc., and then kind of learning from that is, I think, what's going to happen in the next few years. But I don't know what fund 2 is going to look like. But clearly, creating a firm through process is probably going to be one of the hardest things to do.
Let me actually build on what Amit said a couple of minutes ago. He said he was an operator and that kind of like helped him become a fund manager. You've obviously been a serial entrepreneur, been co-founder of some household brands in the country. Now, when you look back on your experience being an operator and now being on the other side as a fund manager, are those journeys very similar when you're starting out at the first time, or they're completely in polar opposites?
Yeah, I think, kind of what Amit said, right? Hustle, I think that's the common piece. As an entrepreneur, you're starting out with a lot of unknowns. You're trying to build out and see, how to add value to your customers, in this case, in the case of a company, and in this case, to your investors. So in some sense, it's similar. A lot of hustle. I think, just figuring out who your investors are going to be, what your, like I said, what your concept is going to be. I think all of that is fairly similar. But I think the difference here is just the timelines, right? So what happens in a startup is almost on a daily basis, you see some progress, whether you're getting customers or you're building a product or you're doing something. So, you look back, every week you're like, okay, you know what, I made some progress. But in a fund, the timelines are just much longer, right? So I think that has been the biggest learning for us. It takes, at least, 6 months to a year for us to actually see that you made some progress. Which is not true when you're doing a startup. I mean, you're doing something or the other, right? Either you're getting more customers, you're getting more revenue, you're building the product, you're doing something on a daily basis. And I think that has been the biggest mindset change, right? Just the timelines are just so different.
Mac, I want to bring you in before I bring some of our LPs into the conversation as well. I know you've built your fund out very publicly and in a way where a lot of people have been part of both learning about you, the fund, as well as the fundraising process. And you made that very transparent and very consciously transparent to everybody. So was there a reason behind why you went out building it publicly, and how has that experience been as a first-time fund manager that you can perhaps share with our second-time fund managers here on the panel?
Yeah, so just for context on this, famously, I raised the majority of my first fund on Twitter. So my first fund was a $10 million fund, and 80% of my LPs came from a connection I made on Twitter. When I started raising the fund, I had 2,500 followers. Today, I have like 62,000, right? And was it a conscious decision at first? Not really. What happened was I knew I wanted to raise a fund. I had been working for an investment arm for a state for a few years, and I'd done some things. I've raised step out on my own, but I didn't have a large enough network of LPs. And so I started off just trying to learn from other VCs, right? And so I started meeting with a bunch of VCs as I could. And as I was learning from them, some of these other GPs I started meeting with started committing like verbally to my fund. And so that became my strategy, and I kind of doubled down on it using Twitter to meet folks. And then here in the US, we have a designation for fundraising called 506C, which allows you to publicly solicit fundraising of your fund or a company, but all of your LPs must be accredited investors. So I use that to my advantage to be able to talk about my fund publicly and began building my fund in public. So now, when we do our quarterly updates, we do them in public. We ship them out. I put my quarterly updates on Twitter, right? And the advantage there was twofold. One, I started meeting LPs and getting interest, and people were able to see my work. Other VCs and other emerging managers were learning from what I was doing, but it also helped us build a brand. And that brand has helped us not only win deals, but also get our founders and other founders that I've met additional resources and funding along the way. Because of my large Twitter network that's growing, if I have a founder who needs help with something, I can literally put out a tweet and they'll find 5 to 10 people who want to help them or who can support them in whatever they're looking for. So that's been really exciting. That's what drives me to keep doing this in public.
Thanks for that, Mac. And now I want to come to Ekta and Rajesh here. So you're on the other side of the table. You've been looking at and hearing some of our fund managers here on the panel today. I want to pose a very different question to you. What do you look for the most in terms of overall growth from a fund manager, other than the fund returns that help you make your decisions when you're looking at them? It may not always be the case that a fund manager has delivered exceptional results, but you would like to back them perhaps for their second fund. Talk us through some of those situations where conviction gets amplified in spite of not so great fund performance. Ekta, you want to go first? Rajesh, who's ready to take this bullet?
I can go ahead. So first of all, if there is an evident not so good track record, that's a red flag. So it becomes difficult to get it passed from any committee in the first place, regardless of how much of our conviction we have. I have one such example to share, and that was not a private equity fund. That was a public equity fund, and in that case, we had seen great track record of the individual portfolio manager, but overall fund track record was not good. And we were actually very excited to invest, but when we evaluated which, when we were looking at the returns, the analysis was that when there was a dip and when there was a in 2020 particularly, right, when there was a short dip around March or something, and then market picked up suddenly, that's the time actually the fund went in the opposite direction, and the bet went wrong, but otherwise had an exceptional performance. But again, regardless of the conviction, it still didn't go through at least my committee at that point. But there have been cases wherein we have invested in first-time fund managers, and technically fund doesn't have a track record to show, but in that case, still look at the track record of the people engaged, how coherent is the team, individual members, what kind of track record they have, and what kind of deals have they done and have been associated, how have they performed. So end of the day, it is the track record. If it's not the core fund, what they're talking about, but in some or the other way, there we need to be convinced of the track record, and that I'm not closing my eyes and putting the fund and giving it to somebody to handle that. That's the conviction we look for. This is about me.
Thanks for that, Ekta. Rajesh, now that you've got a chance to hear everybody here out, what has been your experience? Been there for 12 years now, both as an investor and an LP. Love to get your perspectives on how you look at this from fund management as well as an LP perspective.
Hello, everyone. I guess I'm an oddball on this panel because I don't exactly fit into the first time fund manager category, nor do I fit into the LP category. But I'll share some of my experiences. I've been doing this for 15 years, and to the earlier questions of raising a fund for the first time is always difficult. And when I got into this business about 16, 17 years ago, there was no focus on various stages of funding. Everyone focused on Series A, Series B, and there were very few late stage funds, and none in India to talk about seed or pre-seed and all the other categories we're talking about today. There were none, right? And very few angels who used to invest. So it was a very different time, and you had to go to institutional investors. And when you're raising a serious amount, first time fund always is a difficult thing, regardless of the resume you bring to the table, unless you're already a seasoned investor or have worked at a branded firm prior to that. But patience. The first time you have to believe in yourself, just like entrepreneurs do. First time entrepreneurs do. Not everyone is a serial entrepreneur. Similarly, not everyone is a serial VC GP, right? So you need patience. It takes years sometimes. And I mean, we were fortunate, but I've known people who've been at it for 3, 4, 5 years before they raise their first fund. So I can't speak of much other than patience in that regard, and some sort of experience which is relevant to the startup world, right? Either you're an entrepreneur, that helps. I think LPs look at that kindly. If you were a banker or if you were a management consultant, worked with companies, evaluated companies, understood how businesses work, and understand not just the financial aspect of building a business, but understand the strategy and the pitfalls. Why do some trends work? And the BBC is all about predicting trends 4 or 5 years ahead of time, right? So what makes you evaluate those trends better than others? And why do you think you're different? Why do you think you have that magic 8-ball, right? So it's a combination of many things. Of course, a decent resume and smarts and good pedigree from schools and all these things do help. But coming to the LP side of the equation, I'm not a seasoned LP to speak more in a deeper sense here. But I've looked at a bunch of new fund managers who come to me as an individual, me investing in them. Most of the funds that I've looked at seriously happen to people that work for me over many years, right? So the connect helps. So you know the person, you know their capability. So always going to your close network of people that you worked with in the past, or people that you know, people understand you, people trust you. That's the network I would go to first. And I've invested in one. I'm still evaluating a couple of others. My main purpose here is not to make returns. I'm not here to truly invest my money and make returns. It's primarily to help these first-time fund managers, people who work for me, and I trust them and I want to help them out. And my check is not the most important thing. What they're looking for is my stamp. They worked for me and I'm putting money behind them, and my network, right? I've been able to, the fund I invested in, I've been able to bring at least a dozen people to the table. I think nearly seven or eight of those people invested in the fund. So it helps going to the people that trust you and then ask them to expand their network for you, right? So I'll continue to do this. And the one is to help the people that I know. The second aspect is we invest in Series A and Series Bs, right? And now the pre-Series A world is very organized. It was a very unorganized world, and only angels dabbled in India. And now over the last 4 or 5 years, I'm seeing that getting organized. So when that is getting organized, they're a great pipeline for our fund. So we can't look at thousands of deals that pre-Series A folks look at. We look at more finite set of deals. It's good to know what's happening on the ground at a very, very early stage. So personally being an investor, and we also as a fund, we've invested in a couple of micro VC funds in the past. It helps us just to understand that layer of or that stage of investing better, what trends are emerging. We tend to, but by the time they come to Series A, Series B, the trend is already known, and a bunch of our competitors have invested, or people have been already talking about it. But the micro VC funds, pre-Series A funds, tend to get to the trends better than we do. So understanding where they're actually seeing most deal flow and what kind of early traction they're seeing in these deals, which sectors seem to be working, is a good thing to keep tabs on very, very early stage companies. So both for our own pipeline and to my earlier point of helping out people that that's been my experience so far as an LP. Limited experience though.
You were extremely humble with your answer there, Rajesh. You've been an LP in some fantastic performing funds in India. Now, he said something there, everybody, which kind of makes it, at least if I were listening to that, one thing that stood out to me is he said he's not looking for returns as an LP. Now, I'm going to throw this question at everybody here. Does that mean it puts a lot more pressure back on you because an LP is not looking for returns, because there's a lot more trust involved in that relationship, and therefore you're feeling that brunt of that trust as a fund manager? Now, this is an open-ended question, so anybody who wants to take a stab at this, please unmute yourselves and go forward.
Oh, I'm happy to jump in there because I have several LPs where that was the case for them, and really part of it, some of it is for the trust and the relationship I've built with them over the years. So like I'm extremely incentivized to get as high a DPI as humanly possible because they believe in me and I want to, pay them back for that belief. The other side is the deal flow side. I have several LPs who invest in me because they expect that I'm going to give them truly differentiated deal flow, which now means I think of it as being more proactive in sharing that deal flow and really, giving them that access that they were looking for. And so I'm very, very cautious of that. And it's always in the back of my mind, right? It's like, I really do well by these people, and I want to make sure that when I see amazing deals that I think are in networks they typically don't see, that I make sure they get to see them too. So that does weigh heavy for me.
Yeah, let me compliment what Mac just said. We also have many LPs that said, look, I obviously, want returns, but that's not the only thing I want. I want access to the network. I want to get to know other opportunities, whether it's other startups or whether it's other LPs that I want to network with. Sometimes I want to co-invest with you so that I can be on the boards of those startups, or I can mentor them. I've also some LPs that have said, I want to be you. I want to become a VC. So by being an LP, I get the understanding of how to build and run a venture capital fund, and I will eventually do it myself, right? So we find that there's a mixture of motivations that LPs bring to the table, and it's overlapping circles. It's not that some LPs don't have that motivation, it's that it's stronger for some LPs than for others. We also have some LPs that very much like Rajesh, who say, look, I may be a smaller LP in terms of a check size, but I will bring you many more. And in fact, my data point is, and this may be true for some other folks around the table today, is that my third degree network is 50% of my LP base. So it's friend of friend of friends, right? My first degree network was people I knew. It's about 10% for me. And they introduced to other people, and those people introduced to others. And that's actually the biggest source of LPs for us. So it's people who trusted us and said, I will bring you now other people I trust because I think that there's something here that I can help in terms of a win-win. So yeah, let me take a pause here, pass to somebody else.
Arjun?
Just jump in a little bit here, right? I think all valid points. Our first one was pretty much on trust for the two GPs, right? Me and my partner, right? Relationships built over 15 years, right? In whatever we were doing in the past, right? That was what it was. And, we're very close to closing our second fund, right? We're very fortunate to, that's going to be about 5 times, of course, we're a micro VC fund, right? And I can correlate it to a net promoter score, right? So our LPs from the first fund are now really opening up doors and opening up their Rolodexes, right? And making really warm introductions to their broader network in the second fund, which has enabled us to raise a lot more, right? Which means we must have done a few things to further consolidate and get their trust, right? So obviously, right at the beginning, we were promising those things and they trusted us as people, as individuals, right? And then over the four-year period, we were able to show that most of those, if not all of those, we were able to put into action. And there were some results to show, right? And that really has led, I can see that effect, both of the existing LPs doubling down and putting more capital in the second fund, right? And them really opening up doors, right? Also wanted to pick up on one of the points that Amit made. One of the hustle tactics that me and my partner did, right? And it was part motivation because we wanted to learn more. We wanted to accelerate our learning of becoming better GPs, was investing in a couple of other micro VC funds, but in very different geographies, right? I didn't invest in Mac's fund, but I am tracking Mac's fund regularly, invested in a couple of funds, seed/pre-seed funds in the Valley, right? Just great relationship and rapport with GPs that are functioning in the Valley, learning from them. How do they update their LPs, right? Again, the check size is not large, right? But we just get a seat at the table. We get a quarterly update, right? We know how they're functioning. We know how they're presenting their progress and their transition. And as a first-time GP, that's just peer learning constantly. Yes. So for me, that is an LP investment, but actually I'm investing into myself as a GP, right? Because I'm learning from that other GP who's actually functioning in a certain unique, ecosystem, right? That is already a lot more mature compared to the Indian ecosystem. So for me, that was, again, it happened serendipitously, but it was a hack. And it is something, of course, some of those funds are doing well. So that's the cherry on top, right? Those are other ways. And, trust is absolutely most important to lead to brand. The things that we've done along the way also, we realize the importance of brand, correct? And what does that mean for us, right? We started investing in having a PR firm work with us closely, right? Which for the first 2 to 3 years, we did not find it was so important, or we deprioritized it, right? And we would talk to journalists ourselves, right? But then we realized there's only so much we can do ourselves, right? And the message has to go out broader with more consistency and more frequency, right? And therefore we realized that that's a budget that we need to take out for the firm to invest in a PR firm that, spreads the message for us. And that has, again, reaped amazing benefits for us.
Pranav, I want to bring you in here because, you obviously had a family office as well. And then now you're investing out of 314. So when you were making that decision, and obviously there's a lot more pressure on you for obvious reasons, when you were taking the decision of being a fund manager for the first time, what were some of those things that pushed you beyond the let's say the edge and kind of gave you that conviction that this is a better route for me than perhaps going and joining the family office and making investments both as an LP perhaps as well as a GP? And here you're taking on a different path altogether with your brother.
Yeah, that's for sure a different way of looking at it. Well, it wasn't really a family office. It was more a proprietary capital firm. There were two partners. Although we have the last name, they're not related. The Pais are an extinct species now, but we're not related. So it was more a test of the market in 2011. We tested many asset classes. We allocated to 34 funds globally across asset classes. So we were a large LP. We did many directs. We led the seed round in Baiju. That turned out to be a good decision. Farm Easy, bunch of unicorns, good companies over 10 years, but it looked very scary back then. India was a very different place. And we also learned about the public markets. And the opportunity for us was to survey all of this and see where's the highest return on our time. So we were doing what I'd call asset surveys to understand what we would get out of spending our time in that specific vertical. And for sure, one of the biggest gaps we saw in India back then was the seed stage. We felt fundamentally that this is where over a decade, we can get really a high ROI on our time. Turned out that was, again, a good decision because there were so many successful VC funds in India from that specific time frame. And I think obviously the ecosystem grew very, very much faster than we expected, which was obviously a pleasant surprise. So it looks great in hindsight, but back then it was a very step-by-step logical way of getting to this specific asset class. And thankfully we had some personal experience. I'd worked at a startup. I'm an engineer by training. So fairly close to that asset class. It was always something I wanted to do. So it turned out that it was also a logically right thing for us to do. But there are many ways people come into the industry, right? Some of the best seed funds I respect are people who worked in venture in the US, for example, who came back. Some of the other best people I've seen worked in a large Indian VC firm before they started out on their own. So everyone, I think, at least in the Indian ecosystem, has had a different path to venture capital compared to the standard path of spending 30 years in the industry and then joining in. And obviously we're funding a lot of the first-time GPs ourselves. From 314, we're in 6 VC funds now, micro VCs across the world. And again, it's extraordinary how different their paths have been. So I don't think there's one single path. I certainly think the ecosystem is high variance enough to allow many different types of people to succeed. And certainly all of them raise their first fund differently. That's been a big, very valuable learning for me. See that you don't need to do it the way it was done 10 years back. To do it right today, which is always good news.
Well, that's fantastic. And Maggie, I want to bring you in right now because Pranav said something which is very important. He said it's ROI on time. Now you are a deep tech investor, and we have another deep tech investor in Arjun here. So deep tech obviously takes a lot more time and patient capital that kind of goes into it compared to perhaps some other industries that VCs tend to invest into. How do you see that statement resonating with what you do in terms of the ROI that you see in some of the investments that you've done? Because they take slightly longer for you perhaps to see returns, just the nature of the industry that you perhaps end up investing in.
I think it certainly can take longer. Candidly, we returned the entirety of Fund 1 in 3 years, which even by general venture standards is strong in terms of DPI. That said, we recognize that there's a balance between the really frothy M&A we're seeing in the space alongside the expectation of the companies that will go public that might take longer. Where we specialize is that intersection of deep tech alongside these foundational industries. And so the use cases are really well understood. And I think that in our case, that helps us significantly because we're looking at supply chain, we're looking at warehouse management, we're looking at agriculture and distribution and last mile and things that, you know, everything from TAM to operations are really well understood. And that's a de-risking mechanism relative to the technology itself. The other thing that we're seeing in the space is you know, inverted pressures in that the cost of scaling these technologies, robotic systems and machine learning and computational data sets, those costs have decreased while the capability, and I see Arjun nodding over here because it's really fun right now, right? Like this space is just incredible right now. The capabilities are really increasing. I grew up watching movies like Star Wars and Back to the Future. And, you know, I was always the girl in the corner with the sci-fi book. And those promises are coming to life right now. So even though there are very long time horizons in some spaces, the use cases and the scalability mean that there is a very active M&A market for shorter term exits, and that we are seeing companies get to that public market faster than we expected.
Thank you. Thank you for providing that insight. And I want to bring Ekta into the conversation here as well now, because clearly we've got a bunch of investors here on the panel. You know, we've got people who invest in AI and healthcare, enterprise, agnostic investors, deep tech investors, various stages, pre-seed, seed. So the range is pretty vast out here. I'll pose two questions for you at this point. How do you as an LP figure out your sweet spot? That's the first question. And second, how do you think about new avenues of investment, new fund managers, perhaps, you know, ones who are looking at niche upcoming sectors? Let's take climate tech for that matter. How do you look at all of these and make decisions when it comes to making newer decisions in fund managers investing in interesting sectors?
I'll take the second question first. And one of the methods is what we are doing right now, being associated with so many of the networks. So this is one, the individual network plays a role. Another is we work with banks, of course. So they bring in a lot of new and old, all kind of funds to our knowledge. And if there is particularly something very exciting, we inquire more. And I think it's quite a lot to do with the network itself. And more likely, please don't hold me for this statement. A lot of venture capitalists are here. More likely, it's less that we have to go out seeking for the portfolio managers. Somehow portfolio managers find their way. So that has been, again, that's the benefit of being on this side, I guess. So that is there. And how we decide what kind of, so one is step one, when we set up, like if I have to refer to the family office, step one is we decide on what is our strategy. Very similar to the venture capitalists, they also have strategy where they're going to invest. So we have the strategy as well. And out of the total portfolio size, we do know that how much of the allocation remains for what kind of asset class. And within that asset class, again, what is the focus? For example, when I was part of Astro, which is the family office for Alsair, there we knew the strategic element is technology. We knew the strategic element is education and healthcare, because the traditional business of the company was elsewhere. That was automobile. So we knew that these are the sectors we are not investing. So therefore, what remains with regards to the opportunities and everything. Based on that, we decide the allocation. Based on that, we decide the sector allocation also and the amount also. So thankfully, we were investing into technology when we saw huge boom in last decade, basically. So, but that didn't come random. That was based on the overall allocation of all the assets within the group itself. And with regards to the stage and size, again, it was the whole picture, not just one element of it. Because when we look at venture capital is focusing on one specific asset class. Venture capital is focusing on maybe one stage or a couple of stages, but they know exactly what they are doing. But when it is about the family office, we look at the overall operating business, where we are, if it is at the growth stage, if it is mature, if it is at the whatever risk level. So my experience with different family offices has been based on the core risk profile of the group itself, which is the operating entity and which is the cash cow for the business. Based on that, we have to place the other elements, because other elements must be complementary. If I'm into my operating business is into very risky, then I'm not going to take risk with my investments. If this is absolutely smooth going, then I have the buffer to take risk. And therefore, then I can, for example, in Alsire, business was all set. It was absolutely mature. Even if we don't anything, still money is coming in. So we were able to take risky bets, and therefore we put heavy allocation into technology, because if it works, it works. If it doesn't work, doesn't work. We know when it is about seed or early, we didn't put a lot of money in seed, but Series A, Series B was the sweet spot. We'll start looking at pre-IPO. Those were the deals we were looking at. But we know we could make a lot of money or we could lose money also. We have to take that risk. Again, it's not blind risk, but that is the risk compared to other investment opportunities. So yeah, it's overall portfolio assessment for family offices. A lot of pieces.
This is fantastic insight. And I want to take this and pose this to Rajesh as well. Now, almost coming back full circle, Rajesh, we kind of like mentioned, or you kind of like mentioned earlier on that perhaps return is not the only criteria when you're looking at these investments, but you're also wearing a hat of being at Kalaari on the other side. So when you're making an investment decision from an LP perspective in some of these pre-seed stage firms in the country, subconsciously, how much is some of this playing in your mind when you're looking at it from your Kalaari hat on and saying, hey, this is also an opportunity for us on the other side in case some of these investments of the funds that I'm investing into continue to do well, will perhaps end up being good returns for the fund that is part of my day job. So how does that play into your entire investment decision-making when you're looking at fund managers?
So obviously from a Kalaari angle, like I mentioned earlier, I'm going to be looking at understanding of the trends ahead of time, right? So yeah, every fund that we that we launch, you need to have a certain theme that you're selling your LPs on. So as a Kalaari, as a GP, you're selling LPs on certain themes. What we think over the next 5 to 10 years out, and we're going to be investing over what bets we're going to be taking. So when you're raising your fund, it's important for how the future is going to look, and for that, the pre-Series A funds or the micro VC funds are extremely important, because the investments that they have made and the traction that they're seeing and some of the sector movements that they're seeing could be the theme for me as a GP pitching to my LPs at Kalaari, right? So that's extremely important to understand the trends ahead of time, and that's the hat I wear from a Kalaari perspective when I'm looking at early stage funds, and if I want to make a personal investment, or Kalaari as an LP investing in some of these funds, we have done that in the past. It's purely learning, and for us, returns from these particular funds is not as important as the learnings we get from these funds, and that just because they're year, 2 years, 3 years ahead of where we would be investing, and those micro trends will become mega trends in the future. So understanding those trends early on is what I typically look for.
So these are some really interesting insights, and I know we've got about 30 minutes before we have to start bidding to wrap this up. And I wanted to pose an interesting question to everybody here, both as an LP as well as a fund manager. Obviously, in your experience doing what you do, you end up learning a whole lot about yourself. And you, of course, end up learning a whole lot about the areas of focus for the fund as well. Now, what are the things that you felt that needed to change significantly on your side, both from a personality perspective of fund manager, as well as from a core areas of focus from the fund perspective, that has kind of then made you question certain beliefs that you had and has made you think harder about some things that you thought about yourself? I want to start with Raveen, because you started off, very interestingly as a founder, and you obviously spent a long time trying to understand markets, but also at the same time, you perhaps saw yourself evolve into a different person. Now you're embarking on a new and different journey altogether. How do you looking at the journey that you've had, how are you looking at what are some of the things that you're perhaps looking forward to in terms of that impacting what you do on a day-to-day basis, both from a personal perspective as well as perhaps from the fund level?
Yeah, no, I think, once you hit your 40s, you automatically change a little bit. But, I think one of the key things, I think compared to an entrepreneurial journey, and I've said this before, I think it's just patience, right? This whole journey just requires you to commit much longer periods of time, which you also do as an entrepreneur, but I think you have a lot more choices there. I think you can, do I think a lot of things within your entrepreneurial journey that make it extremely interesting. But here, I think you're just committing yourself to a longer timeline. And the main thing is a lot of your destiny is actually is out of your control, right? So while you're making a lot of decisions based on some trends that you see, you're back as some entrepreneurs, but eventually, really, your brand is your entrepreneur, right? And what happens to you really is at the hands of entrepreneurs. So part of it is just being able to trust your the companies and the entrepreneurs that you're backing. And I think that's a really important one, because when you're an entrepreneur, especially in the early stage, whether it's Mintra, Hoopos, or Nutspot, you control a lot of what you do, right? So you have smaller teams, you're willing to hustle, work hard, do all of that. And you kind of, at some ways, you feel a lot more in control of your destiny. As a fund, I think you have to be able to let go a little bit, and really be able to trust how well your entrepreneur is going to execute. And I think that's good. That's something I still have to learn. I do leave obviously a lot of it to the entrepreneurs, and try not to get too involved in what they're running, because they probably do it way better than I would. But that's definitely been I think it's going to continue to be a challenge over the next few years for us to kind of change.
But I'm going to make this a little bit more difficult for everybody else here on the panel. We're going to take patience out of the equation, because I do get it that we all understand patience is something that we will end up developing. So I'm going to put you all on the spot again and say, let's think beyond that. Let's come up with things that you've seen from your personal perspective impacting both your funds as well as your personality. Now, Arjun, I think I'll come to you, because interestingly, you started out with deep tech, and I think Maggie can double down on this right after that. Deep tech again can be very wide and very, very broad. Perhaps after running a first fund, you then you try and understand that, hey, there's certain sectors we can start doubling down on. Perhaps that could be one of the learnings that you've had over the first fund that you can share with us as well. I'm just hinting at things that perhaps could be an answer here, but you could perhaps have a completely different perspective that you can share here as well. So either one of you wants to go next, that'll be great.
I'll take a shot. I'll maybe leave it to Maggie about sectors within deep tech, right? Because there's just so much to unravel, to be honest. We're still learning. We picked a few themes for the first fund. Some of them are going to be similar, but a lot of them are going to be different in the second fund, right? Within the deep tech gamut, right? So I'm going to keep it there and just learn that. But I do want to respond to the fact of what at least I'm learning about myself, right? And maybe some of it has to do, is more relevant to deep tech as well. It's in general relevant to all we see. But, just the, sales is the crude term, but storytelling is the right term, right? And I was an operator myself and entrepreneur myself before this. And I was, the tech side of things, tech product guy, right? That was not the primary skill that I needed or I used on a daily basis, but that is a skill that I'm using day in, day out. And in today's ecosystem where options galore for Ekta, Rajesh, and all LPs, right? They can see Mac telling his story on Twitter every day, right? or Maggie telling her story. It's just so many options, easily accessible. The ability to structure a narrative, the ability to tell a story, and ability to do that for different stakeholders on a daily basis and refine that. I think for me, that has been the biggest learning, far from where I'd like to be, right? One is obviously the spoken word, but then the written part of it, right? Writing, thesis, writing reports for your LPs, writing one-pagers of why you did a particular deal, right? Writing a Twitter thread on a particular event, on a particular thesis. There's just so much on that front that doesn't come naturally based on at least my own operator background in the past. And that, I think, has been for me the biggest learning, to say, how can we tailor this? Okay, what is the story for the entrepreneur? What is the story for LPs? What is the story for some employees who we want them to join our early stage fund, which is still struggling, still not figured it out, right? And then what is the story for Pranav and larger funds, right? Once we've already invested, right? For follow-on investors, right? And all of these aspects, while there is 50% common, there's 50% nuance to each of those. That's the one thing I just wanted to highlight.
So Maggie, you've been tasked with answering this very difficult question. Arjun just passed the baton on to you. So yeah, if you could share your insights on what you've learned about yourself as well as from a sector perspective.
Sure. I might pass over the sectors a little bit, because if I start talking about that, that will be the remainder of the day. But for the learnings about myself, I think I'd always been really hard on myself because I didn't have a perfectly linear path. I delved into real estate investment, and I've done some work in national security and foreign policy, and I'm curious about a lot of things, and that's a good attribute, but it doesn't mean that I had the steps that look like the traditional venture path. And it's turned out to be incredibly beneficial. And I think that we're at an intersection currently of these applications of various technologies that serve people who didn't necessarily have the linear path really well. And so instead of being a little bit embarrassed about it or quiet about it, I've leaned into that a lot more and owned it, and that's been beneficial. The other big takeaway is much more tactical, and that is just to get incredibly comfortable taking apart portfolio construction and really owning the weightings of how we do the allocations, how we think about pro rata, how we think about leveraging our network to support our startups in terms of LP follow-on and SPVs. And that's been mathematically very satisfying, but also really powerful in terms of overall impact for the fund.
I also want to let everybody here on the panel know that you can feel free to ask other people on the panel some questions as well. We want to use this as an opportunity for people to learn. I know a bunch of you have been pointing at the other panelists and kind of like citing some of the work that they've been doing. So if there are questions that you'd like to ask them, I'd feel you guys should feel free to jump in and ask them questions as well. If not, I'm going to move ahead and pass the baton on to somebody else to answer the same question. But I'm just giving everybody a moment to see if anybody has a question for either the LPs here or the LPs to some of the fund managers on the panel, or all the fund managers to fund managers.
Might be the same thing. I was just going to throw this out because I'm hearing this question a fair bit, and I'm sure that most, if not all of us are, is what's happening in the market, how is that affecting you? And when markets are up, people ask, oh, well, why should I do private markets? I should do public markets. When markets are down, people say, well, why should I do private markets? I need to save my money, right? So I have my own views on it. I have my own answers on it, especially considering I'm a seed stage investor. But I was very curious to know what other people what other dialogues people are having around this question.
When I've gotten questions like that, I've always pushed back with one, we do diversity of stage, diversity of sector, and diversity of time. So we try to mitigate for, the market, because we know the market's going to go up and down. The other thing, and this is specific to Rarebreed, as a generalist fund, we are very specific. We invest in companies based on really basic fundamentals, right? We don't invest in stage, we don't invest in certain verticals. Like, I don't care. What I care about is, do you hit the basic fundamentals of what could be a good business? Are you in a large market? Do you solve a real problem? Do you know how to find your customers and your customers keep coming back? If you can say yes to those 4 things and you're doing those fairly well, you probably have a chance to succeed even beyond certain market dynamics. And that's how we are able to get our own biases out of our own way. We're able to get our biases out of our own way as we make investments, but it also allows us to invest across multiple verticals. So even as markets are going up and down, there are going to be certain verticals that people aren't even paying attention to that are always going to do well. You know, like hair and beauty, like that's a market that just, it doesn't matter what the public markets are doing, people are still going to be going out to buying makeup. Like it's just, that's the thing that's there, right? Or on the other side, certain B2B SaaS companies that may help e-commerce companies work more efficiently. Like when markets are tanking, a lot of people start new businesses. That means there's a good chance you're going to see a lot more e-commerce businesses, a lot more entrepreneurs, a lot more, so as we invest across multiple verticals, that's how we get to diversify. And so our widespread diversification is what allows our portfolio to stay strong, even in different market dynamics.
Hey, Amit, I'll just jump in there and say, I think what you're saying is mostly true for newer LPs, right? For whom the asset class is still being figured out. And therefore, they're wondering whether they should take some allocation out of their public equities portfolio, right? But I think Ekta, for example, mentioned that they do have diversification within private publics, and within privates itself, they will have further breakdowns, right? So obviously it is for the newer LP base, but it is important because the newer LP base is growing very fast, correct? This asset class has grown just multifold in the last few years. And therefore, part of it is education, right? And one of the things that we have done, and maybe the LPs can tell me if you're doing this right or wrong, is we've said, if you start comparing with the public markets, then maybe we got to take a step back and talk about the differences, right? And not do that comparison upfront, right? Because that sort of brings in to say only about the returns, right? But what else do you get when you do private investing, and when you do within private investing, when you do venture investing? And then, of course, within venture investing, what is the difference between series CD, AB, and then pre-seed seed, right? So you've got to break it down and say what the pros and cons of each could be from your own vantage point. And then say, largely don't take money away from your, public equity portfolio, right? Create a separate pool for this, for risk appetite and for the high level illiquidity, right? And think about it very, very differently, right? And think about what else you can get from these partnerships and these relationships. So we try to weave in that nature of a story for LPs to say, this is what you'll get. You could get very interesting deal flow or innovation that could be complementary to, let's say, your core business, correct? You could get early deal flow to then figure out evaluating Series A, B funds as well, correct? And there's an option, of course, to, the beauty of our asset class is obviously to say the ceiling can be almost, there's no ceiling, right? In public markets, there is a ceiling of sorts, right? But we talk about if we find the outlier, right? And of course, everybody claims that we're unicorn hunting and decacorn hunting, right? So if we get the outlier as a pre-seed seed fund, then how big can the outcomes really be, right? And I think it's a combination of these things, a little bit of education for new LPs, and then little bit of showing them what other reasons it makes sense for them to enter into this asset class, and then particularly, our fund. That helps.
I would like to add a bit to this also. Yes, if I have again, there is a decided allocation which is approved and all of that, and every family office would have their family charter and would have their portfolio strategy in place. At least that's how it should be. So within liquid and illiquid, so if I talk about VCs, that falls into the illiquid category, right? And that's usually what we consider the riskier portfolio or riskier part of the portfolio. So if there is more appetite and we are getting better deals, of course, go for it. But when markets are down, the first preference, again, at least it has been for me, markets are down, pick public equity for sure. So we like to do that, and we definitely have some reserve cash. Obviously, I'm sure everybody does that. and we call it opportunistic part, which is reserved for such kind of opportunities. It could be any VC or any pre-IPO random opportunity that comes in, wherein the allocation is not fixed, but there is a range that is fixed, and it could be riskier compared to our other assets, whatever we have, or it could be a sudden drop in the market and we feel we can't miss this. So we do allocate some portion, which we call opportunistic allocation. And especially if there's markets are down, to your question, Akash, we would like to take that advantage.
Maggie, I know you're. Yeah, go ahead, Arjun.
I had one question maybe for Rajesh, Ekta, right, to think about, and particularly in fund cycles like ours. Ours is a 8-year plus 2-year fund, right? We're deploying over the first 4 years, right? And in India, we have about 18 months from first close to do a final close, right? And we usually take advantage of that or stretch it as much as possible, right? Question here is, do you as LPs do full allocation upfront, right, to a fund, or you do a certain allocation and then you can still revisit allocation into that fund after 6 months, 9 months, 12 months before a final close and increase allocation? And should GPs try that as a way of starting small and then showing some working relationship, some updates, right? And like I said, because we have 18 months, right? You take a small check at month 1, then you go back somewhere between month 12 and month 18 and say, can you double down? Does that happen? Is that the right strategy? Just any thoughts there?
So we have done that, but not within the same fund. We have doubled down, and we have, of course, started small to see how the relationship. So when the relationship is new, obviously we start small. Not all, but we do that. People would have based on their portfolio. But when relationship is new, we go with smaller sizes. But if we get more and more conviction and confidence regarding the portfolio manager and the fund and everything, then we do double down in the next fund when they raise again. At least in my track of this thing, I have not done that. I have invested already in fund 1 in first close and have not invested in the second close again with the same fund. Some portfolio managers came in with a different idea, coming in with a slight twist in the strategy, wherein they then said that, okay, now what we are doing is the 50% of the allocation we are gonna invest particularly into this particular type. For example, I invested in a gaming portfolio, gaming fund, and then they came back saying this portion we are gonna allocate particularly for crypto gaming. Okay, and therefore we have now increased the size of the fund, and we are revisiting all the LPs if you would like to do that, and this would be earmarked only for these kind of investments. That was one example that I could think of, where in the same fund, at least we thought whether we want to do that. Otherwise, generally, we don't. So yeah, if that helps.
Helpful, thank you.
Yeah, welcome.
Rajesh, what about you?
Yeah, I think that's how things typically happen with institutional LPs for sure. I'm sure individuals, HNIs who are investing can be a lot more flexible. Institutions typically have to go through a bunch of approvals, investment committees, etc. So you don't want to revisit the same investment multiple times with your IC. So that I have not seen much happen. I mean, in my own experience, having raised maybe 6-7 funds so far, we've never had an LP come back to us saying that we're going to increase our allocation after the first close. If they had come in the first close, they won't come back in the second or third close saying they would increase the allocation. But individuals, I'm sure, do have that flexibility. But the most important aspect of fundraising is the first close, right? And the first close gives a lot of confidence to. It doesn't matter whether individuals or institutions who are tracking you, or individuals might have given a small allocation to you, but the first close gives them certainty, right? And that this fund is going to happen. And whatever the target that you have for the fund size, there's a reason you have that number, and there is a strategy behind the number. There's a strategy behind the number of portfolio companies you're going to have, the check size you're going to write, etc. So if they feel that you're going to get to that optimal number that you pitch to them, possible that they may come back to you in the second or the third or the final close, whatever the close may be, as an individual. But institutions typically don't revisit the same investment twice.
Yeah.
Understood.
Arjun, I just want to jump in here because we just have experience right now because in the final close. And we've had actually many of them come back and kind of double down on their investment, primarily because we've given them co-investment opportunities from our previous personal investments. And that's helped significantly. And of course, most of our money, and to Rajesh's point, it has been raised, most of our money is from individuals and family offices. So they've actually, even when they commit, they actually, come down to the number and then say, hey, you know what, as you get to your final close, we'll just double it, right? And they all come good with their commitments most of the time.
Got it. No, very helpful, guys. Thank you.
Maggie, I know you had a question for the entire panel here before, some of us chimed in. Do you want to come back in and ask a question?
Yeah, I feel like Amit and I shared a brainwave there, and he asked my exact question. So
fantastic. I know we've got
everyone who weighed in on it.
That's great. That's great. We've got about 10 minutes left here. And before we sign off and wrap things up, I want to bring the LPs in again with some of their insights that they've been looking at. And it's been a very interesting year last year, looking at the returns that the funds have been generating for their LPs. So when you're looking at opportunities, both at, from within a new market perspective, as well as markets that have performed historically well for you, where are your minds at in terms of doubling down? Like if the newer geographies that have given you better results than the ones that have been, I know we kind of touched upon sectors, we touched upon stages in the past, but I just wanted to understand how and where your minds are at from a geography perspective, especially perhaps Ekta, you can kick that conversation off and summarize that perhaps very quickly. And how are you thinking about it?
So my focus has always been global, at least from the fund's life cycle perspective. So it was not a geography focus thing ever. It was more of the sector focus and whatever focus, but not geography. But I do know that for whatever reasons, we were a little averse to investing in Asia. We did invest in China. Not directly. We avoid doing certain countries directly. One of them is China. Go through reputed channels only. And for example, there have been amazing investment opportunities, not just through VCs, but direct as well. For example, places like Indonesia. But we were reluctant earlier because of the emerging market and the risk associated with that. I think over a period of time, when we saw more and more growth, so for that matter, even India, again, Alsair has been relatively conservative family office, I would say. So we were more comfortable with developed markets compared to developing markets. But over a period of time, that perspective changed and we started investing. Again, based on various factors, not just how markets performed, but we see more and more unicorns coming from India and emerging markets and all of that. That gives a lot of confidence to take more risk. That is it, if that answers your question.
So the reason I asked the question, and I want to pose this to the fund managers as we wrap things up here as well, is as you're thinking about future funds and as you're thinking about expanding the focus from existing geographies to perhaps a global approach, how are you thinking about bringing back some of your existing LPs into the mix, having heard what Ekta just mentioned? And we can probably take maybe a minute or two to summarize these points on how you're thinking about the longevity of your funds and the strategy that may be associated with Fund 3, 4, 5, 6, open-ended to anybody who's already given that a little bit of thought.
Yeah, so, for Rarebreed, our Fund 1, we concentrated mostly in North America, South America, and the UK. And as we move to Fund 2, we just kicked off raising our Fund 2 on Monday, so fresh back into the market. We are now starting to look for LPs specifically in other regions around the globe who have connections and boots on the ground as we look to create a global organization where we will have individuals in different parts of the world sourcing deals. The next market we're looking to go into very bullishly are Africa and Pakistan. Pakistan, due to the lack of investing that's been going on there, but for a population of 22 million people and less than 300 million in venture happening there, there seems to be a lot of opportunity. And Africa is a gigantic continent where we see in countries like Nigeria, Ghana, with stable ecosystems, stable economies, are doing really well and have the potential to create unicorns. And they're so connected to the other countries close to them that you have the potential for some really huge outcomes. And so looking for LPs very specifically in those parts of the world to help us learn, get boots on the ground, and grow our geography is something that we're thinking about very, very tactically. While also allowing other LPs who are in our Fund 1 to let them know how we're starting to branch out and getting them excited about the potentials of Rarebreed going forward. And we've seen that, we've seen some of our LPs start to really double down on us and really increase their the size of their checks from Fund 1 to Fund 2.
So we do seed, we do AI, I do healthcare, my partner does enterprise. We focus on the US. We have opportunistically invested outside. We just did our second deal in Brazil, and I'm born and raised there, so I know the market pretty well. We probably will do something in India. Both my partner and I have a lot of networks and understanding of India, but we will continue being focused on the US. For the second fund that we're raising right now, the change will be writing bigger checks. We are right now number 2 or number 3 on a cap table. We want to be leading or co-leading the rounds. That's the big change for us, at least. Fund 3 will start doing perhaps a little bit more Series A's, and then Fund 4, more Series B's, and then eventually will become a much larger, but still an early stage fund. That's the goal with Tau Ventures. I'm building this for the next 40 years. In terms of geographic expansion, I think we will expand it, but kind of like what Max said, I think it's very hard to do international other countries if you don't have people there. So I can't expect to do international unless I understand the country or I have somebody there. And we will likely bring that talent into the firm, into Tau Ventures as we grow. But I think that's the story for Fund 3, Fund 4, and Fund 5.
Yeah, in our case, I think we're very focused on India and deep tech in India, right? Of course, there's a flavor of that, which is enterprise software as well, but mainly deep tech and enterprise software in India. Focused again, like Amit mentioned, two of us, the founders and the GPs, we are in India. This is the ecosystem that we know. We've been here 20 years. We have relationships, we have networks, we understand how things work. So we just want to double down here. We continue to be pre-seed, seed VCs, which was for the 0 to 1 journey. We don't want to change that, correct? In our view, we can change, expand AUM over the Fund 2, Fund 3, and so on. But our goal is not really to go up the value chain and start doing Series A or beyond. Our goal is to stay really focused on early stage and deep tech and specialize there and build a brand around that. And then, have, excess capital for follow-ons, right? Reserves, right? And be able to double down on the winners, which, Fund 1, of course, had too many constraints from a size perspective. We could not do, right? Fund 1 is a lot better, but it can be even better, right? We can maybe do just about pro rata or something for another round, maybe 2 rounds. But can we really double down until the company goes the distance and IPO or any other, big exit over a 10-year, even longer horizon, right? That needs deeper pockets, right? And hopefully that'll be the way to think about Fund 3 and Fund 4, right? We are starting to think about outside LP capital, right? Currently, it is mostly domestic. It is 90% plus Indian domestic capital, HNIs, ultra HNIs, and family offices, right? But we are starting to build relationships and ping and say there are pools of capital in Southeast Asia, Singapore, Hong Kong, and maybe a little bit in the Indo-US corridor, maybe at least in Silicon Valley, right? And we'll dabble into those as well going forward.
Fantastic. Do we have any concluding remarks from anybody who wants to jump in before I hand the mic over to Dhruv to providing some concluding comments from his side as well?
I would like to just add, maybe it will help all the community here. that one of our decision was impacted with this change in the percentage change of allocation regarding geography. So we have been huge investors into education, edtech, right? We invested in an edtech fund, and we started seeing that there's a lot of development happening, or the companies coming out of India, right? So overall, it's not just the unicorns coming out of India, but overall, if you talk about the pipeline, would be huge if you focus there, or at least have some concentration there. So we posed this question to our fund, because we had already invested in their previous fund, that why are we not, because we also co-invest, right? So we're like, why are we not seeing any co-investment opportunities coming out from India? And through these funds, we hear this, but not from you. So they said that India was not their focus, and now in their next fund, India is going to be their focus. And when they came back for their next fund, they said, we have dedicated like 20% of the allocation to investing in India only, and we are hiring a partner there. Give us a lot of confidence, because again, we understanding that sector, we knew that there are going to be a lot of opportunities provided somebody's focusing there. So that mattered to us at that time. So whether it helps. So in the next one, they just added that allocation, and also mentioned that they do recognize the opportunity, they would not want to miss it, and they would gradually increase that allocation, obviously, because the pipeline seems to be huge as well. That's it. Thank you.
I just want to give a shout out to 256 as well. And, to be honest, it's helped in a bunch of our fundraising in fund too, right? People on this network openly sharing on such platforms and one-on-one as well, right? So I'm glad to be here, and thanks, Akash, Dhruv, and everybody on the team.
Thank you everyone for joining us. And I think this is something very interesting where we've been building a EFM club separately under 256. Right now we've got like 40 of them in last just 3 weeks. Akash has been helping us, leading that piece with us. And just to end this, I think this is something which we recently come across. Like, first funds have proven to give the highest returns on average across the last 30 years of the data available on Cambridge Associates. So I think this is something really interesting. And but thank you everyone for spending 1.5 hours with us for today. We'll be coming up with the episode 3 very soon. And yeah, have a great evening and have a great day. Thank you so much, guys. Yeah.
Thank you, everyone. Stay in touch.
Thank you.
Yeah.
Good day.
Thank you.